Thank you for joining iMeet. When you hear the tone, you will be the second person to join the meeting.
Hey everybody, good afternoon. This is David Blake with the Tuesday Tech Talk. And today we're going to quickly review the last couple of days and try to figure out what the market's going to do this week. And then after that, we'll look at some different indexes and determine support, resistance areas, and maybe identify some sectors that might be leading the market higher or lower, and see if there's more upside to go to this little rally. Usually we talk about 20 to 25 minutes, and then we open it up for questions. And if you have any questions on individual stocks or industries or targets or anything like that, just go ahead and type them in there, and we'll try to get to them. Last week, what a week we just had. Last Tuesday, we thought Clinton was going to pick up the keys to the White House, and if we got a surprise Trump victory, that we would probably get a 5 or 6% sell-off. Obviously, that didn't happen. In fact, everything last week turned out just the opposite of what the pollsters and the market pundits projected. Last week's market letter remained bullish on the market posture. The CTI, just to update that, we should remain in positive ground now until the first part of December before we turn to a bearish configuration, and that could last until mid to late January 2017. At that time, it's projected that all 5 of the cycles will bottom, which suggests that the market could enter an extended bullish phase at that time. It would take us probably into July of 2017. And the momentum index rose last week to a neutral -2. That means that the Dow Jones is still outperforming most of the other indexes. However, the Russell 2000 jumped almost 10% last week, which outperformed. And we finally got our breakout in the Dow Jones Transportation Index, which was up 6.2% to the Dow's 5.4%, which we've been hoping for quite a while. Sentiment slipped back into neutral, and we got a rise in all 3 of the strength indexes, with 2 of them now in bullish ground. Okay, the market gains last week were led by the financials, which were up a whopping 11.19%. Industrials and healthcare were strong. Medical biotechs were up, according to the Market Edge Industry Group, going to Friday. We're already up about 18%, figuring that some of the regulations would be taken off of pricing with the drug industry. Consumer discretionary materials, infrastructure plays also got a nice bounce. And, of course, small caps and transports helped lead the way. On the downside, again, we had interest-sensitive sectors like utilities, REITs, and consumer staples were all lower and lower considerably. They've been breaking down for several weeks now. Okay, now one of the things that I want to do is when you see the market taking off like that, you want to kind of see if you can break it down to what industries are leading the way. This is where you want to go to see where to come up with new ideas. Now, if you're as a subscriber to Market Edge, if you go to the advanced tools and click on industry group analysis, what I like to do is take all groups and then come over here on the 50-day relative strength button and click on that, so it'll list them by what sectors are strongest and which ones are weakest. Last week, coal, steel, trucking, aluminum, securities brokers, all the banks, Eastern, Southern, Central, Western Savings and Loans, life insurance company, here's the biotechs, money center banks, aerospace, defense. These are the areas where you want to go look for fresh ideas. By clicking on the name of the industry, we'll give you a list of the stocks and list them also by strongest to weakest, which will help you come up with some good ideas. And the idea of this is if you buy stocks that are in the right sectors and industries, normally even if you buy a second or third tier stock, you're probably going to make money. It's the old saying, a rising tide raises all ships, and that certainly is the case when you look for strong sectors or strong industries. On the other side, if you come over here, you can find a list of where you want to get out of. In this case, gold was hammered over the last couple of days. Precious metals, it turns out, was the weakest sector. Then you have cosmetics, personal care. Those, again, are consumer staples, which were weak. You had some of the oil field stocks, which have been weak in there. internet content. We've been talking to some of the daily commentary that the big cap tech stocks were weak last week. The Facebooks, the Amazon, Google, they were all yesterday down about 2.5%. Now we are getting a little bit of a bounce in those today. We talked last night about if they could stay above their 200-day moving average, which they have, you could get a little bit of a bounce, which would help the broader market. And today we have the NASDAQ up close. It's up about 0.82%. So we are getting a bounce in some of the bigger names, looking at Facebook and the Googles and the Amazons. But anyway, over here, this will give you areas that you want to get out of. You ever talk about automobile manufacturers being weak because a lot of automobiles are made in Mexico, and some of the some of the other tobacco, some of these stocks that you may not want to be in there. Here's the real estate investment trusts. These are stocks that if you're looking for short ideas, you could actually click on these and find some ideas just to start go short. Okay, now what I want to do is we're going to look at some of the major averages shortly here, but I want to talk a little bit about hedging some of your portfolio and some of your bond positions and fixed income positions with inverse ETFs. Okay, this will allow you, if you're older, you're looking for some conservative investments. You hate to give up your dividends, but you're not real wild about losing principal in your investment. You can buy some of these inverse ETFs, which will give you a direct hedge or even leverage against your bond funds, and actually make some money while you're still collecting your dividends. So if you didn't sell your bonds or funds over the last few months, you're probably taking a sizable hit on your principal. Over here you can see this first chart. We have the ETF. It's a Barclays 7 to 10 year Treasury bond. Has gone down. We've almost retraced 50% of this move up from the December 2013 move up to the 16. We've retraced 50% of that. We bounced off of this support level right here, which may give you another chance here in the next few weeks to short it again or get out. And you can see over here we're very, very oversold, which announces that you'd also get a bounce. But this is a 2-year chart on this. The symbol is IEF, and what this does, this tracks the actual bond for the 7 to 10 year Treasury bond. You can see the collapse over here. If you've been very conservative over the last year or two, you probably made a lot of money on your bonds and also on your high yielding stocks. This shows that that was rising over here for almost 2.5 years. But when these things roll over, it's time to get out of Dodge. And as you see, some of the moving averages that moved over. Especially, I like to see the 50-day crossing the 100 to the downside would give you a nice exit point. But you can see the collapse in that over here. Now, if you take another look over here, I have on a weekly chart rather than daily. This is the Barclays iShares ETF 10-20 year Treasury bond. Again, you can see the big collapse over here. Here we broke below the 50-week moving average, and we've retraced again about almost 50% of this total move up. You can see the indicators again are oversold. Again, you may get a bounce up in here. If you get one up to the 50-week moving average, that'd be a gift for you to get out of these things again. But I don't think you're going to get that. You may get a little bounce here, but again, this is showing the collapse of that. If you look at another one here, this is the symbol, and this is SHY, shy, and this is the shorter term. This is the 1 to 3 year Treasury, much more volatile, but you're covering small. It's actually in a trading zone between like $84 and 86 something. So you see the big swings in here, but again, the collapse of the short-term bond also has retraced much of what it has, what it's gained in the last 2 years. So if you are in these, you've gotten hit pretty good. And what I want to try to do today is, if you're look at some of your retirement money or some of your conservative money that you want to protect, we're going to give you some ideas that will allow you to get some of this money back, and maybe again hedge your portfolios with these inverse ETFs. And there are times when you get a big movement like this that you can actually do the double and triple leverage things. But in general, you don't want to just buy the leverage ones and hold on to them long term, because they recalculate the net asset value at the end of every day, and that can chip away at some of your longer term gains. But when you see the things get ready to break through a longer term moving average, where you think you're going to get a good move like this, you can buy some of these things. Okay. So this chart here that I wanted to show you is a comparison chart. This is the blue line over here is UUP, which is the bullish U.S. dollar ETF, and then the candlesticks down here, the different color is the 7 to 10 year Treasury, the IEF, which we talked about a little bit earlier. And you can see here that as the dollar is getting stronger, that just generally is bad for the bonds. When the dollar strengthens, that generally means the rates are going to start to rise as you get a stronger currency. Now, not always. Now, sometimes, like back in here, where you were starting to see weakness in the euro, because the dollar was rising against the euro, but you still saw the bonds, the yields actually bonds moving up a little bit, and that was because of we had a stronger economy. So it's not always just the fact that our economy is going great. Sometimes the dollar will strengthen against a foreign currency. Okay, this over here, the next thing I want to show you, this is the first inverse ETF that I want you to take a look at. The symbol on this is TBF, Tom Boy Frank, and this is the inverted 20-plus year Treasury. You can see over here we've bought them. This is a multi-30-year low on these on the Treasuries on this thing. As you can see over here, we started to bounce as they were talking about raising rates in December. We're going to get an up move. And then once the election came by, they thought that Trump's policies would be more aggressive and raise rates a little faster. You got a break above the 50-week over here, and now you ran into resistance right here at the 100-week moving average. So you'll probably get a pullback here. I think you got it today a little bit. If this thing breaks through this again, that means you're going to see an acceleration of this of yields going up. You're extremely overbought by any measure. This is a 30-day stochastic that I look at that you want to rarely is going to get up that high. And here's the 14-day RSI, 14-week RSI up here around 75.80. That's one of the strongest, according to Bloomberg this week. That's one of the highest it's been in since 1990, I believe they said. I had to check that later on, but that was something we picked up earlier on. But this is an idea, just one for one. When your bonds are going down, you buy the inverse Treasury. It'll hedge your falling bond. Now, what you can also do with these things, if you're feeling more aggressive when you get into these things, this is something that's called the TMV, Tom Mary Violin. This will triple leverage your bond portfolio against against the rising rates. Now here you can see this thing's gone from maybe 16, 17 up to 23, so you've already had a heck of a move. You're up almost 50% on that. You broke above the 50, the 100, and the 200 day. Now over here you got this cross of the 50 above the 100 day. That right there is a sign that you could go in. That's usually a trend changer. If you followed that earlier here, you'd have gotten out on these things around 27, stayed on the sidelines all the way down until we just got the move over here to 18, and now you're long again, and that's a trend changer, which goes along with the MACD long term. These technical indicators will work just like they do in stocks. So that's one when you get the breakout that you can stay in those. Once you get a move like this, though, I would suggest you can come out of it and wait for another pullback and go back into them. Take that quick profit and move back in. Another one of these, I don't have it right now, but just so you know, if you want to do an inverted ETF on the 7 to 10 year triple, it's TYO is the symbol on that, and that would give you so if you're following the 10-year yield, which most people kind of use as the benchmark, that would be the one you want to play, the TYO. Now, one other word of caution on these things, you do want to check on how much volume they trade. Some of these things will only trade 7 or 8, 9,000 shares a day. I would be a little bit reluctant to go into those because you want to have liquidity in your investments. If a bunch of people go in there or a hedge fund or somebody that is in there with you, they come out, the bottom falls out of this thing. You don't want to get caught in that. I would recommend minimum probably 35,000 shares need to be traded a day. Above 50,000 shares, I think you'd be fine. Now, the one other point to bring up on these things here, as far as risk goes, probably the immediate and most glaring risk right now would be if you got the Federal Reserve began to talk up that they weren't going to raise rates in December, that would probably cause the dollar to pull back, and also that would cause the yields to pull back a little bit too. Most people don't think that's going to happen, but you never know with this crazy political scene. If Trump's talking about dumping Yellen, maybe she just wants to make sure that the market doesn't have a little rough stretch by raising rates, and she leaves them unchanged. That might be bad for the market. It also might be bad for the bond yields also. So that would be one of the concerns that I have on this thing here. But again, this is the triple yield that you can take a look on that. Okay, the next thing I wanted to pull up on this is when you have this rising dollar, if you've been listening to some of the tech talks, we've talked about emerging markets. We've had some really nice profits in some of these areas. Well, I think the EEM is up something almost 20% for the year to date. Some of the other ones like Brazil, Peru, Chile, some of these Latin American ETFs have really outperformed. And when the dollar begins to strengthen, unfortunately, that's bad for emerging markets. Now, this is the emerging market ETF. The symbol on this is EEM. This is probably the most widely followed emerging market fund that there is if you don't buy the individual countries. As you can see over here, we've got this big collapse. You've got the moving averages rolling over again. Very oversold, but not as oversold as the bonds. If you're going to retrace 50% of this whole move up from the beginning of the year, you're probably coming down to at least 33 on this thing. So if you get a bounce back above the 200-day moving average, it might give you a chance to get out of there. But if you're not, or if you're looking to see these things to continue to fall as the dollar strengthens, again, you can go back and look at some of these different inverted ETFs to hedge yourself or play the stronger dollar against the foreign ETFs. Now, part of this is the technicians will call this intermarket analysis. And if you get deeper into this, what it does, intermarket analysis will show you how different asset classes should respond when something goes up. Just like when the dollar goes up, commodities should weaken, oil should weaken, emerging markets should weaken. And it doesn't always happen, of course. Occasionally it doesn't. They don't work like that. But what's important to know is that you know how they should work, and so you're able to recognize that okay, the dollar's getting stronger, these are getting weaker. This is how it should work, so the trend should continue. But it's also just as important to see that when the dollar gets stronger, then you start seeing emerging markets going up to boot. Then you know that the correlation isn't working, and that may ring a bell. So you don't want to be going short just because the dollar is getting stronger. But in this case, the emerging markets have rolled over, and it might be a case that you can make some money on this to the downside if you don't really want to feel like shorting some ETFs. So to fight what's going on over here, if you want to look at some of the inverted ETFs, the first one I'm going to show you is EUM. That's Edgar United Mary. This is a directly one-for-one inverted ETF. Two things you can look at here. You can draw a trend line in here, which you can see is just broken above a descending trend line. Then here's the Fibonacci retracement. You're not even up yet to the 38.2% retracement on that. I would imagine you're probably going to retrace all of that, which would give you a trade in here from around 25, 26. You should be able to get a trade in this thing up to around 29. That was some resistance and support going back away. So EUM would be a good way to play. You're a little bit overbought. Again, you're getting a little bit of a pullback today, so this might be one to look at. Now, if you really want to get aggressive, we can go back over here. And the next one is EEV, Edgar Violin, and this is a double leveraged ETF. Now, you bottomed out over here right around maybe 16, and now we've jumped from 16 up to around 18. You've got a pullback today. This thing could easily get a trade up here to at least the 200-day moving average around 19. It breaks through that. I think you can get a run on this thing up to around between 22 and 24. Again, you're overbought. Not quite as bad as some of the other ones, but on a day like today where we have a pullback, this might be something you can add to. And again, you're actually trending down here on the MACD long term. This shows you probably have a little bit more action to go. If you're really getting nuts and you want to leverage it even more, this is EDZ, Eddie David Zebra, and this is the triple leverage. This has gone from about 20 to almost 27, 28. This should probably get you to trade up to at least 33 if you buy this on the pullback. And you can maybe even get a trade up here. See, last time it ran a support back here mid-summer around June. You could maybe possibly get a trade up this to around 42. So there's a lot of upside potential in that. Another thing that you may want to take a look at that we look at here. Some of these ETFs that you may want to look at to go into or come out of. The Market Edge ETF Center lists all the developed country and the emerging market countries and puts them in a category for you so you can see where you want to be. In this case, this is the emerging market. As you can see, we have probably 60 in here. This is just showing part of them. They're all avoids. They're all been downgraded. You have a couple in here that just barely long. The longs are all -3 on the score, so they're probably going to be stopped out here the next week or so. We run some portfolios with emerging markets and developed markets that we try to keep them fully invested. Here's the developed market. We can't even get enough. We can't even get 5 stocks or 5 ETFs to go into that portfolio. So we're almost all cash on that. We'll be at 40% cash as of this week, going that waiting to buy, which is good. So when these things bottom out, we'll have a lot of cash in that portfolio to go into, start picking up some of these ETFs when they bottom out. So that's another way you can find some of these areas you want to be out. Now another thing that you want to look at, and we talked about when the market gets strong, it hurts the currencies, some of the other currencies. You go back a notch. And in this case, economies that are very commodity based, countries like Russia, Canada, South Africa, some of the Latin American countries, Mexico, Australia, those currencies will weaken against the dollar as it gets stronger. And if you have some money that you want to park that besides the money market, you can go into the ETFs there, look up currencies, and you can find where you want to be. In this case, you want to be in the dollar today. But when the dollar weakens, if you go into the currency ETF, you might want to shift dollars into maybe Coronas or something like that, and that's an area that you can talk to later on, looking for some ideas. Okay, just briefly, I want to go over we're running out of time a little bit here. But I want to run over some of the major averages. We've had some big moves. What we expect. Were we seeing any negative divergence or any confirmation of what's been going on? Here you saw the Dow Jones break out of this big trading range it's been in. It broke out on very strong volume, which is a plus, which actually confirms it. You're overbought over here. You got a nice buy signal on the MACD long term. Most of the technical indicators are bullish currently, but this is quite a breakout from here. I think you probably will get a little bit of a pullback and another chance to buy into it. But remember, with the Dow Jones outperforming, it's kind of a non-confirmed new high. You want to see the S&P 500 and the NASDAQ also confirm that move higher. So we'll see if we can get some new highs on that. You got a nice move today on the NASDAQ, and it looks like since we started talking, it's actually up almost 51 points. The S&P is at 2173, up almost 10. So that's within about 10 points of making a new high. And that confirms this breakout here. I have a target of 19.3 on the Dow Jones. Now, some of the other confirming things that we look at, and this is a leading indicator. This is the NYSE advanced decline line, and you can see it's not confirming the breakout to a new high, but at this stage it doesn't concern me, and I'll tell you why. We've talked about the advanced decline line on the NYSE contains a lot of preferred stocks, also some bond funds. Back in certain times of the market, we saw where the AD line was kicking out the new highs, and what we were seeing negative divergence in other areas of the market. That was because some of these high-yielding stocks and prefers were moving higher, were being bought while the market was in a trading range. In this case, well, we have something we call the Advanced Decline Line OCO, which stands for Operating Companies Only. That's what you really want to take a look at. You can find that Advanced Decline Line other places. We're updating our site, and hopefully we'll add that to our list of companies. But Operating Companies Only, you'll see this thing outperform, because even some of these last couple of days where we've had a 250-point or 300-point move in the Dow, the Advanced Decline Line is only picking up like 200, maybe 250 units, which is not normal for that. Now here's the NASDAQ Advanced Decline Line. You can see the spike in that thing. We'd like to see this thing continue to go, to push towards a new high if we're going to get a confirmation of the NASDAQ breaking to a new high. Here's another confirming indicator I look at. This is the new 52-week lows on the NYSE versus the new 52-week lows, highs versus lows. Okay, here's the highs expanding out. We had almost 300, 250, 300. That's great. You want to see that. But over here, you see this. You would think this is positive or negative divergence. Because the number of new lows is also beginning to spike here. These are all bond funds and preferred stocks. So in this case, you can ignore that and just look for the new highs expanding. That's what you want to see. Okay, here's the S&P 500. You haven't got the breakout to a new high. However, you can see this downward trending channel that was in and kind of range bound for so long. We did get a spike up of that. We finally broke above the 100 and 200-day moving average, which is bullish. Today's move is going to push this up almost to the new high. You'll just be a chip shot away from that. So that's good. We want to see that confirm the move within the Dow. Here's the NASDAQ. We want to see this. We're at 5270 right at this moment. If we can get a move above 5300, that's kind of the bell being rung, which will also help to confirm the Dow's move to a new high. You're not overbought on the NASDAQ, so you got plenty of room to move higher. The stochastics, you're only over here around 60 something, and your 14-day RSI, you're right around 50. This will go positive today. And the MAC long-term MACD, you still have room to give a bullish signal. You'll probably get that, if not today, probably tomorrow. So we could get confirmation from the Dow making new highs. This did make a new high. This is the Russell 2000. We had almost a 10% move in this thing last week. That's unbelievable. I think it was 10.6% to the Dow's 5.4%. We're above all the moving averages. And in fact, we're getting here's the 50. They started to roll over. It's on top of the 100 and 200 day, and it's turning back up again. This isn't something that's going to. This will move slowly. That's going to start pulling away from the other ones. So that's also confirming. You got a confirmation here. You're at a bullish phase on the RSI. Once you get above 60, if you can push up to 70, that usually is confirmation that the trend has changed to bullish. And here you're getting a bullish signal from the MACD down here also. And that again is confirming the Dow's move higher. And lastly, before we cut this thing off, I've gone a little bit too far again. If you've been coming to the tech talks over and over and over and over, we pull up this Dow Jones Transports. We didn't get the breakout here. Pulled back. Came right up to the breakout level again. Pulled back. Fell lower. Okay, came up again here. We couldn't break out. Couldn't break out there. Bumped against that line over here. We finally got the breakout that we've been looking for right here. This thing had a great move last week. I think it was up about 6.4%. Big moves the last couple of weeks in airlines, railroads, trucking stocks. Some of our portfolios that we do added airlines here the last about 2 or 3 weeks ago. All those stocks, Delta, UAL, SAVE, some of these AWW, they're all up anywhere from 16 to 20% over the last couple of weeks. A lot of they've actually outperformed the rails and the trucks. But this is a big plus. You're going to get a lot of technicians talking about a Dow theory buy signal. So that's something to consider. They'll be looking at this for a longer term move. Does that mean we're going to rally into the end of the year? The CTI, which has been pretty spot on for most of the year. If you've been going long and short, the CTI calls, the triple leverage thing, we're up about 52%. The last one we went long on October 21st, right over here. I think they're up around 7.5% on this last call alone. That's done well, but the CTI is getting ready to roll over here in a couple of weeks. So if we get a little a new high on all the rest of these indexes, I think that's probably going to you'll probably see everybody jumping on the bandwagon for all the bulls. That generally is where you might have a temporary top. So we'll have to kind of watch some of the bullish percentage, bullish advisors to see if that percent jumps up above 55 here in the next week or two, because that could kind of put up a red flag that we've gotten a spike in here and that we could get a little bit of a pullback. But I do think you want to buy any type of a pullback. If it comes down here, whether on the Dow, we get back down here, I think if we could get a pullback to 18.3, 18.4, something like that would be a great buying opportunity, and the CTI stays long in the next summer. So with that, I'm going to wrap it up. I appreciate you taking the time to join us. I didn't get to any questions, but during the week, if you have questions, you can send them to the doc at marketedge.com, and we can talk about them on the on the next Tech Talk. And next week, I also want to go over some of the sectors that we've talked about that are outperforming: the healthcare, the infrastructures, some of the transports, that type of thing. And we'll take a look at the materials and the banks, the financials. We're trying to take a look at some of that, what stocks still have room to go, where we think the upside could be for some of those sectors. You look at the last couple of weeks, where they talk about deregulating the financial stocks, and that's very important. So that allows a lot of upside. These stocks, like Bank of America, J.P. Morgan, Wells Fargo, they have not had much upside over the last 3, 4, 5 years. So they have a lot of upside to them right now. You may start wondering, some people will talk about book value, how they normally trade. Book value is going to go up rapidly as rates go up. Some of these financials, especially insurance companies, and in particular some of the online brokerage firms like Schwab, E-Trade, TD Ameritrade, some of those, they don't have a lot of brick and mortar stores to them. Every time you get an uptick in the rates, that falls right to the bottom, right to the profit level on those kind of stocks. Insurance companies, they have to keep money in treasuries, and also any bump up in rates is just more money falling right to their bottom line. So we do have a lot more upside probably over the next year on those stocks. You might want to wait for the pullback to enter new positions. If you're already in them, hold on, because I think we have a little bit more upside to go. Okay, everybody, I'll talk to you next week. Thanks again.